Greetings and happy Sunday. It is Jeff Scott here, and this is my weekend review for April 17th, 2016. It is approximately 11 a.m. The futures are not out, and neither is any results from the DOHA meeting, although I think if something comes out positive, it might be a big surprise since apparently Iran is not participating. So, on that note, let's move forward. I entitled today, Earnings Seasons Arrives at Resistance. Based upon the number of big stocks with earnings this week, it's pretty clear that the next quarter is coming right now. And we'll show you why the comment about resistance is there. Disclaimer, this is for education purposes only. Any recommendations are in the spirit of education and should not be considered investment advice. I'm a doctor, not a broker, and most physicians lose money with their investments, so take that with a grain of salt. I am not affiliated with any software vendor or trading company. Tools I demonstrate are those that I use in my daily trading. I have paid for everything I demonstrate. Trading involves risks. You and you alone are solely responsible for any investment decisions you make. As always, I like to start by calling out the folks that I've learned from and whose work is dotted throughout this presentation. Really a marriage of two worlds with a little bit of extra spice. CanSlim, as propagated by O'Neill, improved by Morales and Katcher, and taken to the next level by Woodward and Brown. Meets John Person. John Person is a friend, mentor, teacher, trader, software developer, who has a number of tools which I use to take the stocks that I find with CanSlim and then find actionable buy points. And then I'm also able to scan the market looking for some very high probability trading setups that John has come up with. A couple of his more recent books. And the spice would be a little bit of Van Tharp from Position Size and Money Management, and my buddy George Lee, who's taught me a lot of things over the last several years. I own a lot of software tools, and I want to emphasize I own them. Everything I demonstrate I purchased at some point. I need a real-time platform. I can use TradeStation, Thinkorswim. I find that they're both a cut above anything you can get from the other equity brokers, especially in relationship to outside software development. And then I use Genesis, which I think has got the cleanest charting but requires external data for futures and an account to trade on. From an analysis perspective, I live in HGSI and EdgeRater. I do like seasonality. There's 3 good programs out there. I paid for each of them and use each of them. And then there's a number of websites. Because I do go to HGSI a lot, I just wanted to put this up here for a couple of reasons. One, the website's highgrowthstock.com. The second thing is under investing strategies. This is a screenshot, so I'm not going to do it. If I hit on investing strategies, you'll see my name pop up. And if you go to my blog, you'll see videos going back a number of years. If you go up here, you can see it's a free 30-day trial, no credit card, and that you have leaders of this world, including Gil Morales, who are active users of the program, and he's got a comment about that. The other promotional thing to mention is that John Person is holding a seminar in Florida in September, the 24th, 25th, 26th, kind of where we live in Palm Beach area. This is at the Hilton Garden Inn in Palm Beach Garden. He prices it, I think, very fair, of less than 1,500 days for 3 great days. Those that register soon will get hotel for 2 nights covered. In addition, if you're interested, you need to let me know as soon as possible. I am going to have a HGSI Unleashed meeting on the 23rd, sort of a prequel to John's meeting. It may be too much for some people to do 4 days in a row, and I get that. I've had a couple of people confirm already. I need to get at least 5 people, and then that meeting will go. I think we're already there, so I would assume that that will happen on Friday. And there'll be 2 prices. There'll be a price for those people that are attending John's meeting, which will be discounted from the regular price, and that price will be defined by how many people come, because I don't do these to make money, but I don't want to lose money giving a day of my time for education. Stock patterns are cyclical. Where are we? Wow, this is the toughest chart I have because every week it feels different. It feels like we're living where my arrowhead is here. Are we at the end of this bear market rally, or are we really in the beginning of a new bull market? I don't know how you tell that until you wait and see. I mean, there's certainly AD lines reaching new highs, OBVs heading up in most of the indices. That's suggesting that we could go further, but we'll show you some charts, and it's pretty clear that we are sitting right on resistance. And then you have to know how to play the market. So there's a lot of undercurrents. So for example, we know, and I already mentioned, that in DOHA today are a lot of oil producers. Now, I don't think the prices on oil have discounted the likelihood that nothing comes out of that meeting. So it's very likely that oil may be under pressure this morning or Monday morning. We'll look for futures tonight to give us some signal. So how did you play that? Did you lighten up your oil stocks? Did you buy a contra ETF to oil? Did you go to cash in your portfolio? All those would have been reasonable. Did you buy puts or collars on existing positions? Did you sell out of the money calls? There were a lot of approaches that you could have done regarding the DOHA meeting. Now, if something happens and Iran does show up and they do decide to do something, this market could rocket higher in oil. I just don't see it. My play was I lightened up my oil positions, which I went heavy in the beginning of the week, kept some just in case, and then took advantage of very cheap premiums and bought a crap load of ERY, which we'll talk about later. So you look at Friday's sector review, and what do I see? I see energy was weak. And financials were weak on Friday, but I got to tell you, they weren't weak on the week. In fact, you look at Bank of America, which will be here somewhere, I'm sure. Did Bank of America get dropped? Well, Bank of America actually got above above $14. So the bank stocks had a nice run. They gave back some on Friday. Also giving up were broker-dealers and insurers and credit cards on Friday. And I think that must have been some softening in the market. It was a slow day, but they did have both energy and finance had a great week. Materials have been strong. Consumer staples picked it up again at the end of the week. Last week they suggested they were weakening, and again, with slowing of the market on Friday, utilities perked up. If we look at the major markets and think or swim, we notice that we are well above the 17-day moving average, which has crossed above the 200. We're about to get a golden cross of the 50 above the 200. This is the E-minis. Closed near the high, although gave up a little bit at the end of the week. NQs, same story. YMs, same story. And then notice on the TFs, the Russell futures, they've stalled at that 200-day moving average for 3 days in a row now. That's going to be sort of a line in the sand. If we can get above that, I think this will pull the rest of the market higher. The reason why my premiums were cheap on my ERY is because we're getting down to remarkably low levels, and the lowest level on this chart for the VIX, and the dollar is languishing here below the 17-day moving average. And if you look at the weekly charts, you could see we're firmly above in those green circles, above the major moving averages, and we're sort of stuck here between the 200 and the 50 on the TFs rather. And then if I look at my Genesis charts, and we're just going to point out these green triangles, you can see every major market. This is daily in the middle, weekly in the bottom, 60-minute on the top, 5 minutes on the top. The daily and weeklies are in buy signals for each. And then XLF, despite the fact that they were soft on Friday, was strong on the week. And what is that telling me? This is the 10-year Treasury yields, and they're still pretty darn low. This is a weekly chart. They were a lot lower here when they got down to 1.5. I guess people thought the world was dying. This must be near the bottom of before we started the rally in the bear market. So Interest rates pulled up a little bit this week, but are still fairly low. But why are we seeing strength when I looked at charts over the weekend in regional banks and insurers? Does somebody think rates might be going higher? AD lines, the Russell 2000, small stocks on the left, big stocks with the Russell 1000 on the right. Now look at this. We are in multi-year high. In fact, probably all-time high in the Russell 1000. So there are a lot of strength in big stocks. If I had looked at, for example, the NASDAQ 100, it's at an all-time new AD high. And then we've been short-term overbought on the with stocks above the 40-day, and we're sitting right here, which is actually right here. It's 87% of stocks are above their 40-day moving average, and now we're getting up to about 53% of stocks are above their 200-day moving average. So we're getting to a place where in the 200 we're kind of fairly in the middle, but on the shorter term moving averages we are near extremes where you would expect the market to relax some. If you look at 1 month new high, new lows, again, we're approaching 10-year highs, which are up here. And McClellan is sort of in the middle at just less than zero as it works off its overbought condition. The buckets, so this chart looks at three things, last week to this week. The pie chart represents the number of stocks in green in the S&P 1500, which are trading above the midline of their Bollinger Bands. Above 70 is bullish, above 80 is starting to get extreme. And then each bucket from 0 to 100 plus a bucket below and a bucket above, taking a slice. So that Bollinger Band, how many stocks are in it, and as we get more and more overbought, you'll find higher and higher numbers of stocks outside their Bollinger Band. And since they live within their Bollinger Bands 90 to 95% of the time, if something gets too far above or below, it's likely to revert to the mean. Right now, it just tells me we've gotten a little bit more overbought, but we're not at any extreme on the buckets. No Hindi in sight. That would require 4 or 5 things to happen. A Hindenburg occurs at market tops. It's kind of the volatility that's seen as the large holders, the money managers start selling the stocks to the small guys like us. Indicative of a top, we do not see one. Last week I was concerned about, or middle last week, this kahuna, was that a shot across the bow of the bulls or just a one-day aberration? And you could see we've gone back to a lot of green on the Woody indicator, which is a percent B times bandwidth. So we're back with bulls regaining the upper hand. Canaries in the coal mine, last week they had pulled back to the 200. The question was the 200 going to hold, and it tested it 3 days in a row, and then it broke out. The canaries, which are Facebook, Netflix, Google, Apple, Amazon, Priceline, LinkedIn, and Tesla, look like they want to take another leg up into earnings. The Lowry buy-selling pressure still is the thing that makes me think this is a bear market rally, or one of them. And you could see the selling pressure is far above the buying pressure, which is not usually what you see in a bull market. This is a list of leaders that I put together April 6th to give me a sense of when this market rolls over. And as I looked at it this weekend, I really scratched my head. And I asked the question, if this was a strong week in the market, and it was for my portfolio, then why were the leaders lagging? And they really didn't change. So I have a tool called Edge Rater that I took the stocks and said, well, this rally started around the 11th. So let's look at all the stocks from 212 to now. And let's get a sense of what led higher returns. So the first thing is we'll look at EPS rank. In a strong, typical market, the higher the EPS rank, the better the earnings quality, the better the performance. Notice here, earnings per share rank was a negative. Those that had the worst earnings had the highest performance. Relative strength rank. Typically, those stocks that have been the leaders continue to lead, and the higher relative strength rank stocks have the highest gain. Well, since the bottom of this market, the biggest gain has been in the stocks were the weakest. And group rank doesn't seem to make a big difference, but frankly, it kind of looks like the lower group ranks actually outperformed. Then I look at A to D, accumulation and distribution. A and B are accumulation, D and E are distribution. And one would have expected the stocks that were accumulating up to February 11th to outperform, but that's the opposite we saw. And then boxes have to do with earnings growth year over year and then 5 years. And stocks with the beefier earnings are boxes 1, 2, and box 7 usually outperform. And you could see it's hard to say that anything's outperforming, that people did well regardless of boxes. And then I summarize it up here with ERG, which is EPS plus relative strength plus group. And it looks like the lowest ERG stocks had the best performance. How do I explain that? Simple. Massive rotation into minerals, silver, miners, energy, and what you had is junk coming off the bottom. Cleveland Cliffs, U.S. Steel, Tech Minco. Look at your gold producers. That's not usually what I would expect to lead the next run of the bull market. So I think this was actually more evidence that this is a bear market rally. And as I said, we are coming up to resistance. Know your news and EPS dates. So from a news perspective, got some leading indicators, some Philadelphia Fed housings and weekly jobs numbers. You know, there's some important stuff there, but probably the most important is this DOHA meeting. So looking at my Reuters International News feed, I see that the DOHA oil debate are now moved into the third hour after it was postponed earlier. And it seems like the big thing there is getting Iran to participate. And if Iran doesn't participate, then perhaps they're going to just all cheat, because Saudi Arabia said without everybody participating, they're not in. So you're going to see lots of banter, of saber rattling, and that could cause futures to go all over the place, both energy and markets. Then you have Kuwait lowers crude refining output as workers strike. Well, maybe that's something that would have caused a spike in oil. It's about 400,000 barrel reduction, but that'll probably get lost in the Doha meeting. I mentioned earnings, so here's a quote that I made. It is a judgment call to hold stocks over earnings dates. It is bad judgment to not know when your stock's earnings date is scheduled. You need to know when every stock you have has earnings. There are some big ones this week. I'm not going to go through all of them, but suffice it to say, if you own stocks, whether it's American Express, whether it's Morgan Stanley before the market opens on Monday, if Netflix on Monday afternoon, there's a good chance that you own something on this list. You can go to levittbrothers.com. It's a great resource to get this information at no cost. Market thoughts was a nice week in the markets as the emergency Fed meeting was a non-factor. Economic data has been weaker and the setting of stronger employment. No rush to raise rates in the absence of inflation. Major market indices are at resistance. Earnings season's off and running this week. Doha meeting will set the sentiment, especially for energy, and we enter a seasonally strong time in the market. Here's something that I look at every day, and I combine two things. And we're going to look at the charts in a few minutes, the person buy-sell signal, which would be the word in each box, and then the color of the elder impulse indicator. Green means it's okay to be buying or holding. Red means it's okay to be selling and holding. You don't short when the color box is green. You don't go long when the color of the box is red. I look at the major market indexes as well as the sectors, and it's pretty clear to see how strong last week was as we've really reverted to buy signals in every time frame on the major markets, and pretty much except for staples, which still has a sell signal, and utilities on the daily, we've gone to weekly and monthly buys across. Now note that those two sell signals on the daily are despite a blue and a green impulse, so not necessarily a place to be shorting the market. Now I watch this daily because it gives me clues as to what market direction is, and certainly at end of day Friday this market was strong. So the usual agenda. Chart of the week, these are stocks I present for educational purposes only. Trading, especially options, carries substantial risk of loss. I do not warrant any expectation of return. I may or may not already have a position. I plan on taking the trades that they execute so I can discuss on the following session. I am doing this not to provide stock tips, but to openly discuss how I take the trade, why I chose a specific stock or option strategy, and where I would plan on taking profits or placing stops. So this is kind of indicative of last week and frankly this week, where we have a lot of stocks in the bottom of their panel that are bottom of their channel that are starting to stir. So this was Devon Energy last week. I also liked a bunch of these other energy stocks, including Consolidated, which I think is a coal play, and XOP, which is the oil producer ETF. And frankly, I took most of these trades at Monday morning because they all look the same on the person stuff, which was a high close doji with bounding weekly OBV. So I said go long at 29.35, first target 33.20, and stop at 25.50. Here's what we did. We traded right up to, you can't see it, but this dashed line is resistance 1. It was actually pretty good because you had the chance to get in right above our buy price, or you got in the day before on Monday or Tuesday at the beginning. I got stopped in. Market traded up every day this week, but ran into resistance at the R1. What it says in the small print is I'm still in the stock. I took the trade exactly as I defined it, but I raised up my stop to break even and took half off because of the DOHA meeting this week. We'll come back to this week's chart of the week and we'll see what I came up with for discussion. So quickly, let's look at TradeStation. Let's go into my market force and divergence. So again, we're looking at several things here. We're going to look through the major indexes real quickly and the sectors. We're looking at the arrow, which is the person buy and sell signal. We're looking at the color of the paint bar. We're looking at these little red dots, or on the bottom will be green dots, which suggest a divergence, suggesting we may be ending the price move. I guess for the purposes of today, that's fine. NASDAQ, daily, weekly, monthly, green, 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 arrows everywhere. We've got some divergence dot coming in here, suggesting that we might be getting a little bit of a MACD divergence. And frankly, if you want to see that, there's a lot of MACD divergence there, actually. So let's do my drawing window. Let's look for a trend line. So the market's clearly going higher, higher high. And let's look at this MACD. The MACD is clearly not, so that's why that light is up here as we took a higher high, and we haven't even broken the zero line on the MACD, so that tells me there's a lot less market participation pushing this market higher, and that might be a chink in the bull armor. All right, let's look at the Dow Jones Industrials. Green, green, green with buy signals everywhere. Dow looks very strong. Let's look at the S&P 500. Green, green, green on buy signals throughout. And you notice these are those MACD convergence showing me that we were getting MACD divergence to the downside, or MACD convergence, as John would call it, lower low but not lower low on the MACD, followed by a recovery of the market. S&P looks good, and then the IWM, which despite the fact it's lowest on the charts in relationship to its moving average, has probably had the biggest move. We're in a buy buy, all green with some MACD divergence. So, as I said on my call that I did Wednesday for the PUG group, the video which I posted in an email to the HGSI forum this weekend on Saturday, but not on YouTube, the markets still look very strong. Real quickly, the sectors, the materials are in a buy throughout. Everything is green. Energy starting to waver, went blue here, but still in a buy everywhere, also blue on the weekly. Financials, which were weak, had a nice move this week, as I mentioned earlier. Buy on the daily and weekly. Interestingly, on this chart, it looks like it's in a sell on monthly, but it's blue, so green, green, and blue. Industrials have been strong. Green, green, green with buy signals. Technology lagged a little bit. I think Apple spooked the market with some issue about phone sales, but buy signals throughout. Staples, which had been the big leader, sold off. Still in a sell signal short term, but it went blue here. Notice the MACD divergence on the weekly, also blue despite a buy signal on the monthly. Utilities perked up on Friday, but you could see they'd been in the process of selling off, although they turned green on Friday. Blue on the weekly, still in a buy signal on the weekly and monthly, according to John. Healthcare started to move again with a buy signal midweek. Blue, buy signal weekly, buy signal monthly. And then discretionary looks good throughout. So going through, you can see, I said before about utilities and finances. Finances did good beginning of the week. They sort of slowed down on Friday, as you can see here, still very positive. And utilities had a bad week, but popped up a little bit on Friday. All right. Now let's move on and take a look at the markets in HGSI. Let's go to major market view. Do top-down view, price and volume, heavily weighted towards the last day, then the last week, and then very little rate, but some the next three. Led by small and mid-cap, NYSE, because mostly, I guess, a lot of the oil and the miners. And the laggards for the week were volatility, commodities, semis. That can't be good. Let's take a look at some of the indexes. S&P 500. It's sort of playing, this is what I wrote weeks ago, that, what would good look like? Wasn't going to go straight up to this resistance line. Good would look like back, moving up and backfilling, and that's kind of exactly what we did. You could see this is the major resistance line right here, and we are just under it, and we had a couple of doji days. So we're stalling out at major resistance. If I look at the Dow, also at major resistance as we approach what's right here is the end of 2015 March high, where we ran up to it and we failed. So the Dow, although it looks great in relationship to the moving averages, right up at resistance. If I look at the NASDAQ composite, got a little bit more ways to go, and we're sitting here. Let's clean this puppy up. Broke above the moving averages, a 17 crossed above the 50. My bongos are green. But the challenge here is, there's a number of potential resistance areas. There's one here. There probably was one here, which we've broken through. So does the NASDAQ run all the way up here? And we're probably going to see some resistance where we failed up here. So we got a number of areas of resistance. The NASDAQ actually looks like it has a little room to potentially run. And then the Russell 2000, which, as I said, has really been strong. Let me just show you how strong it's been. Off this bottom to falling, we're up 20% in 44 days. Now, mind you, we've run right up to the 200-day moving average. So we are, I think you can see pretty clearly that we're sitting under resistance across the board. If I go back and I look at the VIX is down kind of as low as it's gotten. Now, as I said, or frequently say, I know my friend George always likes to remind me, when the VIX is low, look out below. When the VIX is high, get ready to buy. I agree with that. A rising VIX is bad for equities, but who knows when it's going to go up. So I'm going to watch that VIX, but know that a rising VIX will make my puts and calls more expensive, but it also foretells some short-term pressure on the markets. Right now, the VIX is low and not moving. The other thing that's low and being challenged to move much is the dollar, and the dollar is struggling to get above its declining moving averages. If this was a stock, you'd be thinking of shorting it right here. If dollar is weak, then what about gold and silver? There's been a bit of a disconnect in that silver has been just massively strong, remains strong, while gold has been strong with a weak dollar, but gold does not look the same. Again, silver breaking out to new higher highs, and gold pulled back some but had a nice day on Friday. What I think the biggest news on gold is that it looks like we've truly changed the pattern. Just look at a weekly long-term chart. And that we have now sustainably got above that 50-week moving average. Look at the volume, OBV picked up. Now, we got major resistance sitting here at about 26. So the question will be, can the GDX, the gold miners, get above this point? And that will be interesting to see, because that's where that they had 200 weekly. So let me just stick a 1,000-day moving average on this. Edit current view. Let's go add indicator. Let's put out a simple moving average. Okay, make it 1,000. I don't know what a Q is. What color do I want to make it? Let's make it orange. Okay, I think that this is going to be, that's my target now, and I think that's going to be the challenge. Can I get above? Because this market has had a big move, but it's still in a long-term downtrend. But it's definitely changed its character from where it was not many months ago. Oil, I'm not sure if it's even worth looking at oil, because it's all about DOHA. And oil has had a great run. This is kind of compressed, isn't it? It's hard to even see much here. It's something like SCO. So this is the ultra shorts. What is it? SCT? I can't remember. Let's see, WTI. I'm trying to remember what the best ticker is. Oil. Let's see. Well, here's short oil, and you could, so the long oil will be the opposite, and you could see that oil got to its recent high here and backed off as the week ended, going into DOHA. All right, let's look at industry groups. All right, hold on a second. I didn't feel good about that, so let's see. Another way to look at it, and as I mentioned, this is how I'm playing this right now, is I actually went and took a big position, not in ERX, but in ERY. So here's ERX, and you could see the energy bull ETF is just hammered. Kind of looks like gold. Big resistance sitting right here. A way to play a drop in oil related to DOHA would be to look at ERY. And I bought into ERY early on the day on Friday. And actually it's profitable already. But ERY will move a lot more than the price of oil or the USO. And this to me was the way to protect my energy positions. Industry groups. We start with 171. Still have 75 on the short-term upside. Led by precious metals, biotech, REITs, diversified banks, bank steel, e-commerce, specialty pharma, IT, and specialty apparel. Many of those are growth stocks. So part of the small and mid stocks leading. If I look at what's weak, oil-related exploration, midstream, integrated oils, marine shipping, coal operators all suffered on Friday. Now, they were all super strong last week and strong throughout the week until Friday's softened related to this DOHA conference. Hence why I took off a lot of my energy shares and why John was, pretty adamant in his room that people should lighten up on their energy. So I like to right-click and go through the leaders here. So I mentioned silver was strong. This is a stock that I liked a lot. Hold on a second. Let me get into my appropriate view. Everything looks so much better with higher resolution. But if I go higher resolution here, you guys will kill me because you'll need a microscope and it'll take you forever to download. So I'm not going to do that to you. All right, so First Majestic Silver, this is what a leader looks like. Turned positive February. Over the last 21 days, it's up 31%. It's up 150% since the beginning of the year. Doesn't make any money. It does have revenue. Clearly, this is being driven by the price of silver. It's extended, it's probably late, but I wanted to show you what good looks like. Fortuna Silver, same exact pattern, a little bit lower price. Franco Nevada, Goldfields. Now, if you believe gold is going higher, here's a precious metal stock, unhedged gold producers. So that means if gold goes up, they make a lot of money because they haven't hedged their production. We're sitting right at support at $4. Gold Resources. And actually, that's not the way I should be doing that. I should be going down this list, so excuse me for doing that. So let me just do this. So First Majestic, we looked at, here's Newmont Mining. Like many of the gold stocks, pulled back a little bit, maybe giving you a new buy point. Notice the doji on the weekly. AEM, Franco Nevada, Randgold, all their charts look the same. You probably need some gold exposure. There's a lot of different choices. Next one down is biotech. This is an interesting play, PTCT. PTCT is a stock that's been in a long downtrend. They do make a muscular dystrophy drug. I think they had an EU approval over the week, and it got people all excited that maybe they're going to get a US approval. UK regulators recommend DMD drug. Muscular dystrophy is a horrible disease. There are no drugs on the market that provide much value. There are a number in development. BioMarin has some, Sarepta, and apparently so does PTCT. Getting an approval in England is shocking, especially before we've approved it here. I would consider this to be very high risk of getting approved in the US, but it probably runs from here because people will start buying it thinking that the US is going to approve it. Medivation, I made the mistake Wednesday saying I'm not going to chase this. I still don't want to chase it, but this is a drug that's a company that's in play. It does have some good earnings coming up this quarter. They do a co-marketing relationship with Astellas, which is a Japanese company, on their main product. they will probably be acquired, and that's why the stock is moving. Don't know when. Gilead, slowly and stealthily making its way back up to the 200-day moving average. Gilead has been the poster child of high pricing with their hepatitis C drug. It doesn't have much earnings per share growth. It's sitting on a ton of cash. Its enterprise value is probably worth more than the current price. It trades at a multiple of 7.89, but it's undervalued because of the pricing concerns in healthcare. It'll be interesting to see if they can make a transformative acquisition with the cash that they have and regain their growth. Don't know anything about Celator, except what an interesting pattern. A Bible gap up here, and it just kept on running. Doesn't make any money, so it's another story. Ariad is constantly being talked about being acquired. They brought in a new CEO to get acquired. I'm not sure if some of that noise is starting to make the chatter. You had a Kahuna, a gap up here, mobile breakup from a squeeze. Doesn't make any money. Does have a drug on the market. Trexon. And then Celgene, doesn't look as good to me as Gilead, but I bet this one gets above its 200 faster. This one still has some growth in it. So biotech patterns don't look great except for that cheap one I showed you. Juno, I do have a position in this one. Doesn't mean it's going to work, mind you. I've had positions in this before in Kite, and they have little runs and then they die. Celgene has a big investment in this company. This and Kite have a new generation of cancer-fighting drugs called CART, C-A-R-T, and I think this is one that can move. Just look at my position on it, and it did break above the 200 this week. There's the index. I don't usually go below the index. Next one down were REITs. Man, were there a lot of REITs on my buy list this week. Here is Prologis, nice break above the 200, pays a 3.7% dividend. Are these guys starting to get extended? Well, this guy's at a multi-year high. DDR, moving up off the 17th. Mobile breakout. Kahuna, pocket pivot, 4.3% dividend. Great earnings per share growth. Equity residential, not so hot. Essex property bouncing off the 50, pays 2.8%. SL Green. There's some great REITs out there right now. And I guess this is the argument that interest rates are not going up. If rates start to go up, these will become less attractive. Diversified banks. I mentioned Bank of America back above 14. So Bank of America, despite having ho-hum earnings, had a nice move up off the 50. This is a move here, which doesn't look like much from the lows to the high before it rolled over on Friday, of about 12% move. So a big move on Bank of America after earnings of it, and JP Morgan pays a teeny-weeny dividend, does make money. Citigroup, looks like the same chart. JP Morgan a little bit stronger, although failing at the 200. I like to see it break above that before I touch it. So banks running into resistance, especially JP Morgan. What about smaller banks? Here's First Republic. There are a couple of these that I liked. Recent move up. KeyCorp. Fifth Third. The ones that I liked, let's see if they show up here anywhere. PacWest Bancorp was one that I looked at this week. Very similar patterns here. Moved up sideways the last 2 days. This one pays a 5% dividend. Talmer Bancorp, certainly a leader in the banks right now. Breaking out to a new high. Great earnings per share growth. So there are some banks, regional banks, that look good. Another way of playing this, frankly, go back into this, could be just to buy KRE. Which looks just like the banks in the beginning, and it is an ETF of regional banks. Steel producers, I got position in X. I still can't, you pinch your nose. And there was a real good reason to buy X. X had met every one of my buy criteria. Here, again, around here. If you look at persons signals that had a number of high closed dojis, earnings per share growth are horrible. Revenue keeps dropping, but this is one of the best looking charts in the market if you just go back to the middle of February in this recovery. Remember I said this is a rally of junk off the bottom. Folks, I give you junk off the bottom with a doji down here and basically a turnaround. Have no idea how long this goes, but I'm going to ride it a little bit longer. Steel Dynamics, this one actually makes money with earnings per share growth. MTL, or MT rather, Nucor, another one with earnings per share growth. So steel producers look good. E-commerce discretionary. Notice the first two here, Amazon and Netflix. So what we're going to do is we're going to go look at both of them in Seasonality Trader. So first let's look at them here. Amazon, I have a substantial position in Amazon, so I'm biased. Weekly bongo went green, great earnings per share growth, kind of catching up to its PE. As long as Bezos doesn't do something stupid. Today I'm reading about Bezos buying an airport in Germany, just what Amazon needs. God, I mean, someday the guy will just turn off his space program and whatever, buying jumbo jets and buying trucks, and just let the earnings power of the world's best retailer take over, and you'll have $1,000 stock or more. He may get there anyways. I'm hoping to see it go back and retest its highs. But hope is one thing. We'll see what reality is. It's probably not that much tied to the price of oil. And then what's in a really nice uptrend here, in fact, it's pretty impressive the turnaround Netflix has done. And Netflix did something that, since I own the stock, see a nice big move up from here. Music to my ears was they're raising price. Is anybody going to drop their Netflix subscription if it goes up $2 a month? I don't think so. I think they've got plenty of price raising power. Both on Monday afternoon on Netflix and 10 days from now on Amazon. Do we have any clues about what might happen this year? Here's Amazon, and this is seasonalitytrader.com. It tells me that it's been up 7 out of 10 last years. Average return on the up years is 11.6. On the down years, it's 2.7. And I could look at that white line is what happened from here over the last couple of years. 2010 was not great. Here's 2007. 8 didn't do much. 12 had a nice little pop. 11, nice little pop into earnings. 13 didn't do much. 9, not much. 6, not much. 15 had a nice little pop. And 14 didn't really do much with earnings. I'm looking at the white line. Bottom line is, here's the channel we're in. This is a growth channel of 79% if this was an annual growth rate. It's just a very short period of time of the chart. And we're in a seasonally hot spot, which is why the green. Here's today. Here's the earnings. Be nice to see it if you're not long Amazon for it to cycle down to the bottom of the channel before earnings and then break to the upside. I've got a long position. I will probably be hedging it to the short side before earnings and selling some out of the money calls to pay for that hedge and keeping my long position intact. That's not ignoring earnings, but that's saying I'm willing to protect myself $20 or $30 to the downside from where we are today and sell some out of the money calls to pay for it. What about Netflix? So Netflix also looks kind of interesting from a seasonality perspective. And Netflix has also been in a nice uptrending channel at the top of the channel. It has a 9 out of 10 starting April 15th to May 26th with a 30% return. So let me tell you about what that means to me. Technicals trump seasonality. Okay? I always look at the chart. Is that a strong looking chart on Amazon? Absolutely. Is that a strong looking chart on Netflix? Absolutely. Am I willing to buy this based upon a stock that's broken above the 200? Everything is green there. Had a pocket pivot on Friday and recently had a couple other pocket pivots, a kahuna mobile breakout from a squeeze. Absolutely. Absolutely, yes, interested in buying it. When I then go and I see that the seasonality is extremely strong at this time of year, that gives me more of an incentive. Now, what kind of a move do I expect it to have? Here's the problem with Netflix. It's expecting a plus or minus 13-point move. That means options are going to be massively expensive. So let's say that you believe me and you think it's going up to 124. If you want to buy a $120 option, this is the hard part, or this is why you're not going to trade unless you're already in. Even a $120 call on Netflix that expires in 4 days is $2.20. Here it looks like a 10-point move in the next week. So it's a pretty tough stock to call it a buy. Now, on the other hand, I'll probably sell some calls out here during the day. Make a little bit of a free return because if it goes to 125, I'm probably happy to sell my shares. That's a big move. I'm not sure. I don't think I see that move, but we may. And then the other issue is when I want to buy some puts, I'm probably going to let this one run. I like the seasonality, but more importantly, I like what I see in the chart. JD.com, sort of a junior eBay, a junior breaking above the 200, still in a downtrend. It's been languishing in this area. eBay, VIPs, Mercado Libre, the South American eBay, looks the best of those. But I'm going to stick with Netflix and Amazon, and I'm long both of them, but I may have some protection on by the time the market closes tomorrow. Specialty Pharma. Now, these have been under assault because of Valiant and pricing things. Don't know anything about Nevro. It doesn't make money. Had a big move over the weekend. I'm curious what is their story. So I left click, then I right click, then go more from web, left click on FinViz. It'll bring up FinViz and it'll tell me, oh, I get this. Probably because I'm not logged in. Well, for another time. They had a new approval. Okay. Don't know anything about them. Love the chart pattern. So a cup, handle, breakout. Zoetis, also breaking out. Raptor. Saw some big upgrades on Acorn. Acorn had some accounting issues. They delayed some of their filing. The stock used to be a $50, $60 stock that I used to own. I saw some $36 price targets come out, which would be a 50% move from here. Get you back up to that descending trend line. And that's because on March 22nd, they did release their financial reports. All right, what else do we have here? Number 9, IT services. Infosys breaking out, Bible gap up rules apply. Closing right in the middle, a little bit below the middle. That would bother me a little bit. Must have had earnings come out. Next earnings are not till July. IBM, a growth stock again. Boy, not that I bought this at the bottom, but IBM, since this market recovered, maximized up 29%, 42 trading days. Again, hate to say this about IBM, but junk off the bottom. HP, the enterprise computers, great earnings per share growth, pulling back after a big run up after it was spun out. EPAM, this one probably I like the most. Great earnings per share growth. Long uptrend, pull back to the weekly, 50 weekly moving average. Looks like it wants to run again. EPAM is on my buy list. It had a PSAR breakout on Friday. Everything is green, makes good earnings. All right. And then the next group down is specialty apparel. On Wednesday, we liked Francesca, but decided it was too thinly traded. Limited brands. You know, this time looks like it's running up to the 50 to become another shorting opportunity. Chico's FAS, where my mother shops, not known for high fashion, but had a pocket pivot and a kahuna on Friday, mobile breakout from a squeeze. If Chico's can get above this 200-day moving average, it might be interesting. You can put your stop probably either at the 200 or down at the 17 and be safe. It does make some money. It has some growth in earnings. Urban Outfitters, pull back to the 50, would have probably been a good chance to scalp some there. I'd be looking for a breakout out of this level. That looks pretty good too. TJ Maxx, same as Urban Outfitters. Lululemon, the same. And Burlington Stores is already starting its breakout. All green, earnings not to June 14th. So there's actually some good-looking charts in specialty apparel. All right. I'm getting tired. I don't know why it's only noon. Let's look at some of the stocks that made it to my buy watch list, specifically my filtered buys. There were a lot of stocks that I thought looked good this week. These are the stocks, many of which we've already looked at. Amazon and Netflix. Let's just look at some of these going down the list of why I liked them. And then we'll end with my stock of the week. All right, we already looked at Amazon. We know the earnings are out in 10 days. Netflix earnings are tomorrow. CMG, why did I put this on my buy watch list? CMG obviously hammered from some health concerns, whether it was sabotaged by unhappy workers or what, who knows, who cares. It looks like to me like it wants to go higher. Had a kahuna and a pocket pivot on Friday, broke above some moving averages. It's got to get above that 50, but I'm going to watch CMG closely, see if I can buy some at a relatively fair price compared to the past. Google or Alphabet, both of them look the same. Looks like Amazon and Netflix is broken above its moving averages. Looks like it wants to go higher. Electronic Arts, don't know much about it. Got to get above the 200, but it had a number of pocket pivots and kahunas and a mobile breakout from a squeeze, and even the weekly bongo went green. U.S. Steel we already looked at. Freeport-McMoRan is a copper producer, also has some oil and other assets. Broke above its moving averages. This too, from the bottom, has had just an absurd move. Not as absurd as U.S. Steel, but pretty darn close. If you go back to middle of January, and if you're still in it, you've had a 200% return in 60 trading days. Obviously, when you have a stock that was down so much over the last year, it's probably not that surprising. That's a big move. Olin Corporation, gosh, this one was tempting for my stock pick of the week. Specialty pharmaceuticals or specialty chemicals makes money. Kahuna, everything turned green out of a squeeze, broke above the 200. Lowe's Corporation actually looks better than Home Depot, although they're very similar. They've sort of having sort of a consolidation, a high base formation. If a breakout above here, it did have a squeeze, and a pocket pivot on Friday could be interesting. There's three distributors, Amerisource, McKesson, and Cardinal. All of them have been down on their luck. Mostly, I think, because 2016 has not been a great year for new generic launches. That's when they make their money. All three have a similar pattern. They've pulled back, they've been basing, and they're all starting to have some life. Here's AmerisourceBergen, a couple of kahunas, mobile breakout from a squeeze. Earnings growth accelerating, plays a small dividend. PNK is a gaming stock that's already broken out and running. Devon Energy was our pick of the week last week. Here's Home Depot, very similar to Lowe's. Has earnings, needs to break above that PSAR dot. Frankly, that could have been a pick of the week as well, because if it breaks out above that little red dot, that might be something. I already own it, which is why I didn't pick it. Dollar Tree, I guess for them and one of the other FDO or somebody else merged. Been choppy, still choppy. I get a sense that it wants to break out here. Everything's turned green. Mobile breakout from a squeeze and a kahuna and a pocket pivot. Worth watching. First Majestic we looked at already. International Paper. I like the pattern when it breaks above its moving average and then finally tests and holds. Had a couple kahunas. Mobile breakout and a squeeze. Everything is green. Don't like the earnings per share growth. Pays a 4.2% dividend. Newmont Mining is a gold stock pulling back after a big move up. Insurance company, Traveler, same chart pattern as Lowe's and Home Depot. Sort of a high base here, pull back into here. Kahuna in a squeeze, taking out that PSAR dot, I think would be a new buy signal. Match.com, I wish I would have had this when I was a single boy in the 80s. Would have been much easier, but I met my wife through a singles group, my religious group. So I guess it's the same thing as Match.com. It worked for me. Stock's starting to work for me too. It's obviously an IPO. It's been in a downtrend. It looks like it's changing its tune. Mobile breakout from a squeeze. Everything's turning green up here. Kahuna and a pocket pivot. One that I'll be watching. Ferrari, also an IPO, had a breakout on earnings on Friday. Kahunas, pocket pivots, squeeze. Everything is green. Cemex, Vulcan, and several others, U.S. Concrete broke out. This is Cemex, which is one of the world's largest cement companies, and it's looking like it wants to break as well. Not as pretty fundamentally as the others. So, by the way, this is a list of stocks that I saw from pruning this week that looked interesting. There were a number of utilities that made my list. As a stock, it's chopping around sideways. It had kahunas and pocket pivots, a squeeze, and everything's green. What not to like is the fact it's going to have some resistance trying to get above the 200. What I did like is it pays a 7.5% dividend. AT&T pulling back towards that 50-day moving average. Perhaps this is a chance to get in on a telecom play, which may not be that exciting, although they seem to be taking share. But what's exciting is a 5% dividend. I bought CTL at the beginning of this run. It pays a 6.7% dividend, similar chart pattern. Adeptus Health, don't know anything about what they do. Are they psych? I can't remember. Freestanding emergency rooms. Obviously in a big downtrend, held at the 50, several times retested, had a mobile breakout from a squeeze, everything's green. Great earnings per share growth, lots of demand for this, so this is something I'm going to watch. Earnings are this week, which would be something that I would probably wait until after earnings came out. Michaels, I think they went private after being a public company and came back out. We're about to take out the post-IPO high. One of the guys I like to listen to, Dan Fitzpatrick, that's usually what he starts to look for. I see a stock that's in a big uptrend. Everything is green. It's getting extended, but it's what I'm watching. ELS is one of the REITs that's been a big winner. You could see it's up It's up 5.8% from the beginning of the year, but it kind of is a nice steady move up along its 50-day moving average, which is a good price to buy. It's sitting on the 50. It had a kahuna. That's the reasons to buy it. It's got some red up here, which is the reason not to buy it. It pays a 2.4% dividend. Another energy or utility stock. This is First Energy. Good earnings per share growth, 4% dividend. Mobile breakout and a squeeze up here. Great Batch is a medical device company. I was intrigued by this chart. Don't know enough about this stock to tell you what they do and whether it's a safe one or not. But I kind of like the pullback, sort of basing down here. Had a kahuna, mobile breakout from a squeeze, big increase in volume. The stock makes money, has earnings growth. Not sure why it got discounted here, but this is one that looks like it's moving. I will tell you that one of the things that's happened this year in the medical device world is there was a 2% tax on medical devices from Obamacare, which I guess is going away, which should improve some of the bottom line on these companies. You know, all year long I've watched this company go up and not taken a trade in it. You could see a great pattern since September, big move up on this water utility, 2.2% dividend. Not much earnings per share growth, but if there was ever a time to want to buy it, it's now. It's gone sideways, so it's been basing since February. Had a mobile breakup from a squeeze. I got a high close doji here. I got a pocket pivot and a kahuna. If I can take out this red PSAR dot, this could be a buy, and that might be a place to set my buy stop is right above that, and my sell stop down here. I'm not risking more than 4 or 5% on this trade. Cardinal Health is another one of those distributors. It also has medical supplies, so it benefits from the reduction of the tax. It's got earnings per share growth coming back in. It pays a teeny weeny dividend. It's got pretty good leadership. I don't expect them to miss their numbers, especially with more generics coming out in 2017. I think that this might be a time to get into the distributor game. Randolph Resources, another gold stock. EPAM we looked at. If I had to pick an airline, well, this is the one I own. I own two, Delta and Hawaiian. Delta I own outright with shares, and then I have some calls as well. Hawaiian, what I basically do is, well, Hawaiian I have a long memory, unfortunately, and my long memory is this, where it missed earnings. You notice it's got earnings this week. It got clobbered when it missed earnings. So because of my long energy, I buy calls, and every month or two when they expire, I roll them out to a higher strike price and take money off the table. So even when it crashes, I'll have minimal that I'll lose because I booked profits the whole way up. Hawaiian looks great. Earnings per share look great. Its PE is much smaller than its earnings growth. If you get these earnings and the PE stays the same, one thing has to happen. Stock price goes up. Even if PE comes down, price goes up. Empire State Realty Trust, I like the earnings per share growth. I like the kahuna. Everything's green, pays a 1.9% dividend. Here's another REIT that I liked a lot, WP Carey. Everything's green, mobile breakout from a squeeze, kahuna, pocket pivot, PSAR reversal. This should have been my buy pick. I don't know why I didn't pick this one for my pick of the week. Great fundamentals here. It pays a 6.3% dividend. So how would I play this one? There's got to be a reason. Let me go into TradeStation and figure out why I didn't pick this one. So there has to be a reason. I think it was probably right by resistance, but let's see. Yeah, so here's WPC. Here's R1, here's R2. That was my concern. It has a high close doji with super strong OBV on both the daily and the weekly. It's in a PPS buy signal. Frankly, this would have been a good pick. So this one looks great with person's indicators. If I was to trade this one, Pretty simple trade as far as I'm concerned. I set my buy stop above the high of the day. The high of the day was 62.57. Closed at 62.37. Let's set my buy stop at 62.60. 62.60 is where I would go long. All right. Where would I put my stop? 60.71. 60.63. If I put my stock at 60.60, that means I'm risking $2.60, which is for a little bit over 4%. And my target would be about 66. At 66, so let me just put this out on the chart, because this is how I trade, and that's what this is about. I'm going to put a buy order in, and I probably will. I like this too much to not. Right above the current price. Let me try that again. Let's say I'm going to put a buy order in right above the current price. All right. So I want to move that up a little bit. So my buy order, I said, would be at 62.60. So I'm just going to, this is not like TradeStation where it's not as customizable. But let's say the buy order is right here. I'm going to put my stop at $60.60, which is kind of going to be this bottom right here, a little bit below this. And I'm going to put my stop I'm only risking $2, I'm sorry. Unless I'm risking less than 4%. I'm going to put my stop about, my target about here. And the way I'm going to trade this is I'm going to say if the stock trades up to 62.60 on Monday, I'm going to get filled. I'm going to put my stop right here, which is very protective, risking only a couple of percent. But it's good because if I violate the last 4 or 5 bars, including this big down bar, why would I want to be in this? Now, you could put your stop, if you preferred, at the 200 or the 50-day moving average and give yourself a little bit more room to run. But to me, if I violated this point, it doesn't count. I take my one-to-one profit. I take half off here. I move my stop to break even at that point, and I let my profits run. And that's how I would trade it. WP Carey of all these stocks looks very interesting. Premier Inc., they're a large group purchasing organization. They work with the distributors. They behave like a distributor. Nice move off the bottom. Had a pocket pivot on Friday, breaking above the 200 mobile breakout from a squeeze. Here's another REIT, Lexicon Realty Trust, 7.6% dividend. Energy Recovery, I actually have a position in this. Nice up move. Certainly has had a big run on a weekly chart. You could see it even more. It's sort of getting to a climax. So I will raise my stops, not buy more. But it's kind of this earnings per share growth got me interested. Another REIT. What a beautiful lower left, upper right. This is COR. Pays a 3% dividend. Equity One, not as pretty, a little bit looser, but sitting on the 50 with a kahuna, one of my favorite buy signals, 3.1% dividend. Hotel Investors sitting, broke above the 200. Everything is green. Good earnings per share growth. Here's another popular REIT. Notice how many REITs are on my buy list. That's not typical. Builders First Source, it's already had a big run. Not sure why I put it there. Struggling at the 200. Here's a Energous, a electrical equipment stock. Nice run up here, high base, sitting below the PSAR dot, setting up something that I'm watching. Innovia is a small biotech company. I think they own a lot of royalty patents. Great earnings per share growth. Pays a 3.7% dividend. Orbitech, high base up here, ready to break out. XL Service, IT Services, lower left, upper right, with a base here, right below the PSAR dot, looking for a breakout at this point. Eldorado Resorts, another, this gaming and lodging stock, big move up, lower left, upper right, no dividend. In Top Build, an engineer a construction company, I just like the flag it was forming after a big run up. Looks like it's going to reverse here. And then Apollo Residential Mortgages, Specialty Finance, 14% dividend, Bible gap, or gapped up here sideways, big dividend play. Lumentum Holdings, technology company, lower left, upper right, IPO. So those were the stocks that made it through my screen of 3,000 stocks. What I do with those is I run them through TradeStation, and then the filtered buys, which is this list here, were the ones that came out of my TradeStation review. Not that we're buying the index, but this is pretty typical of what I look for. Stocks that have bottomed, that are making their move, that are reversing and coming off the bottom. Lots of pocket pivots. This is the index of my stocks. So all these stocks we've looked at already. I looked at each of these in TradeStation, and let's go to my stock of the week selection. It was tough. There were a lot of wannabes. I probably should have picked William Carey, but I didn't. So let's go to chart of the week. As always, these are for education purposes only. Trading involves risk. I do not warrant any expectation of return, or I may or may not already have position in stock. I plan on taking trades that they execute so I can discuss. And I'm not doing this to provide stock tips, but rather show you how I think. So I decided to go with Encana. Encana is in the energy complex, but it's more gas, both exploration and transmission. It broke above the 200 with a couple of kahunas, a mobile breakout from a squeeze. And now, as shown by the 2-day force, it's in a small pullback and held at the 200-day moving average. So there's a lot of things I like about this pattern. I like the fact it's mostly green above. It's still in a squeeze. It broke out and is now retesting. And a successful retest, it might go higher. It pays a teeny-weeny dividend. On my person package, I see it had a high close doji on Friday with a huge OBV move over the last couple of weeks. It's in a PPS buy weekly and daily. Was in a squeeze up into here and then broke out. So you got a flag after a breakout. So if market's stable, I'll be long at 685. First target 740, stop at 630. That's risking 55 cents per share or 8%. I can buy 3,600 shares. I won't put the buy stop in until the market opens. I want to see what the market does. Obviously, this is a market that could be pressured by what happens in DOHA, or more likely what doesn't happen in DOHA. No new news from DOHA that I could see. But, I mean, the overwhelming message here has got to be careful. We are at resistance wherever we look. Are we pausing to refresh at resistance? And a great earnings season will propel us to new highs and taking out prior highs. I think you can make a case for that. Or are we at the perfect opportunity for the market to start thinking, we're already in April, May is 2 weeks away, 3 weeks away, and will we use a strong earnings season or a weak earnings season to take our profits and head to the Hamptons for the summer, and in which case the market goes back down. I think that this is a bear market rally. I think that this resistance will hold. And as much as I like to think, and it may break out and retest, I have to be aware of risk to the downside. Pug user group is something that I formed a year ago. It's predominantly HGSI users, not who have purchased John's lifetime trading package. I've also included those people that have John's lifetime package, even if they're not HGSI users, because it's a chance to make them HGSI users, but it's also, it's just a great group. I had a session for them this week, which I did open for HGSI folks to see what we do. John comes in monthly. He does teaching. It's really, it's something that every product should have, which is dedicated education to support the people who buy the product, because we don't want you to buy it. I don't want you to buy something on my advice and then have just sit there and never be used. That's why I've been helping HGSI for over a decade. That's a big driver of what Ron and Ian has done. And in regards to John's program, he's really taken a big part of helping the folks that have bought the package. Again, just reminding people the seminar, I try and be very respectful to Ron and Ian and not to pull people from their seminar. But since they've announced that they're not going to hold their October meeting, at least a live meeting, that Ron's going to hopefully do some great online sessions, I decided that it was okay then for me to come out and actually promote this. And as I mentioned earlier, on that Friday, I'm going to be holding a session that'll be more geared towards HGSI, and I will be speaking at John's as well. So on that, hope to see you in Florida. Have a great week. If you're super long energy, you better hope for a good DOHA resolution. If you are not long energy, then if we get a sell-off in energy, it might be a time to come in. The futures aren't open yet. Be interesting to see what happens. I played it both ways. I have a number of positions, as I've mentioned several times. I took profits, and I now have smaller positions than I had, and then I balanced them with a very large position in this. And this is that contra ETF. And, you know, if you look at the options on ERY, actually, let's go to, see if I can do this. Oh, I don't really do this often on demand. So let's look back at Friday. Actually, let's go to Thursday. And when I did this, oh, you're not giving me a price? Not going to do it. All right, let me go back and get out of on demand. Bottom line is, I looked at ERY at the time it was trading at about $19. And I looked at what a $19 call would cost me. At the time, it was probably half that price. I hate doing this, but let me see what the trade is. They were $1.58. Okay. So you can trade like a millionaire when the instrument's $1.58. So what I did is I went in and I bought 100 contracts at $1.58. How much can I lose on this trade? 15%. I can, excuse me, $15,000 basically. It more than hedges my long positions in energy. If energy dumps because of DOHA, I have a number of call positions in energy that have prices in the dollar range. So I will get wiped out most likely on a lot of those energy positions. So the way I look at it, for the first couple of dollar move in oil, this hedges me. But let's say oil dumps, and oil dumps down to 30. A lot of my call positions will become out of the money. But I only got a dollar or so to lose on most of the positions because I have relatively inexpensive calls. This thing has unlimited gain if the market tanks. So I have hedged my position, and in fact, they're already up in value a little bit. I made 30 cents, so I made $3,000. So I'm going to watch these like a hawk. If oil doesn't fall, then I'm going to get out of these right away. But I had to do this so I could sleep at night, so that I figured Friday oil would sell off, which is why I bought them, I think, on Thursday. And then on Friday, oil did sell off a little bit. But it's all about protecting myself against a perceived bad result in DOHA. On that note, I'd like to thank everybody. Say goodnight. Say goodbye. It's too early to say goodnight. And remember, we're near resistance, and you got earnings out. Have a great week. We'll see you next week. Goodbye, everybody.